Welcome to the DX Today podcast, your daily deep dive into the AI ecosystem. I'm Chris, and joining me as always is Laura.
Thanks, Chris. I am genuinely fired up about today's topic because it might be the single biggest number in the entire technology industry right now, and almost nobody outside of finance is really talking about it.
Okay, you've got my attention immediately, so let's not bury the lead here. What is this enormous number that has the whole investing world holding its breath this season?
The number is roughly $700 billion, and that is the combined amount that just four companies, Meta, Microsoft, Amazon, and Alphabet, plan to spend on artificial intelligence infrastructure in a single year.
Hold on, $700 billion from only four companies in 1 year? That figure is so large, it almost stops meaning anything to a normal human brain trying to picture it.
That's exactly the right reaction, and to make it concrete, the most cited estimate puts it around $725 billion, which is up roughly 77% from what those same companies spent last year.
77% growth year over year on an already gigantic base is the part that makes my eyebrows climb. So where is all of this money actually physically going in the real world?
It is going into data centers, and I mean enormous ones, packed with graphics processing units, custom chips, power substations, cooling systems, and the land and buildings to house all of that compute at a truly industrial scale.
Let's break it down company by company, because I think the individual stories are even more revealing than the aggregate. Who is the single biggest spender at the top of this leaderboard right now?
Amazon takes the crown this year with a capital expenditure plan of around $200 billion, most of it for data centers. And that figure actually blew past the consensus expectation of about $147 billion.
So Amazon didn't just spend a lot. They spent dramatically more than even the optimistic analysts were modeling, which tells me something important about how confident they feel about demand for this capacity.
Right behind Amazon, you have Microsoft expecting roughly $190 billion in capital expenditure for the calendar year, which is a staggering commitment for a company that already operates at massive scale.
And what about Alphabet? Because Google has historically been a little more measured and disciplined about how it talks about spending compared to some of its more aggressive peers in this particular race.
That discipline is gone, Chris, because Alphabet has guided to between $175 and $185 billion, after revising its guidance upward 3 separate times from an original range near $70 billion.
3 upward revisions in a single planning cycle is honestly wild, because it suggests they kept discovering that whatever they budgeted simply wasn't enough to keep up with the demand they were seeing.
And then there is Meta, which is the company that arguably kicked off the latest round of investor anxiety, raising its own guidance from a range of $115 to $135 billion up to a range of $125 to $145 billion.
I want to put Meta's number in perspective for our listeners, because just throwing out billions gets numbing. How does this year's Meta spending compare to what the company actually spent the previous year?
This is the jaw dropper, because Meta spent about $72 billion last year. So the new guidance means the company is very nearly doubling its capital spending in the span of a single year.
Nearly doubling. And what is driving Meta specifically? Because I assume there's a strategic story behind that number, rather than just a vague desire to spend money on shiny new hardware.
Meta points to 2 things: the build-out for its superintelligence labs effort, which is its big bet on frontier models, and also higher component pricing, meaning the chips and parts themselves are simply costing more than before.
That detail about component pricing is fascinating and a little ominous, because it implies that some of this spending growth isn't buying more capability. It's just paying inflated prices for the same scarce hardware.
Exactly. And that scarcity dynamic is a recurring theme across all 4 companies. Because when everyone races to buy the same chips and build in the same power markets at once, costs naturally get bid up.
Now here's what I really want to dig into, because spending this kind of money only makes sense if there's a payoff. Are investors actually celebrating these announcements, or are they getting nervous about them?
It is a genuine split, and the nervousness is real because when Amazon revealed its $200 billion plan, the stock actually dropped somewhere around 8 to 10% as investors digested the scale of it.
An 8 to 10% drop on what is supposed to be a bullish growth investment is a clear signal that Wall Street is not uniformly convinced this spending will pay off quickly enough.
Analysts at Mizuho captured the worry well, flagging that this potential doubling of capital expenditure could leave very limited free cash flow this year, with returns on that investment still quite uncertain at this stage.
Let's unpack free cash flow for anyone who isn't a finance person, because I think it's the crux of the whole anxiety. Why does spending this heavily actually squeeze the money these companies have left over?
Free cash flow is essentially the cash a business generates after paying for its operations and its investments. So when you pour hundreds of billions into data centers, you are draining the very cushion investors love to see.
And there's a second, sneakier problem lurking underneath all of this, which is depreciation. Because these massive data centers and all that expensive hardware don't hold their value forever, do they? Over the long run?
Not at all. And that is the quiet fear, because all of this equipment gets written down over time, and investors worry that depreciation and operating costs will outpace the near-term revenue that AI is actually bringing in.
So the bear case, if I'm summarizing it fairly, is essentially that these companies are spending like the future is guaranteed, while the revenue to justify that spending hasn't fully shown up on the books yet.
That's a fair summary of the skeptics, but there is a genuinely strong bull case too, and it rests on actual monetization evidence rather than just hope, which I think is the most important part of this story.
Good, because so far this has sounded a little like a doomsday sermon, and I'd love to hear the other side. What's the strongest piece of evidence that this spending is actually translating into real money?
Amazon's chief executive, Andy Jassy, made a striking claim, saying that the company's AI capacity is being monetized about as quickly as it is being installed, which is a remarkable thing to say at this scale. But
that phrase, monetized as fast as it's installed, is a powerful counterpoint, because it suggests there's no glut of idle hardware sitting around. The demand is essentially absorbing supply the moment it comes online.
And the numbers back him up to a degree, because Amazon's cloud division reached an annualized revenue run rate of about $142 billion, with growth actually accelerating to 24% year over year.
Accelerating growth at that size is genuinely impressive, because the law of large numbers usually means growth slows down as you get bigger, not speeds up, so that reacceleration really does say something about demand.
Google offers maybe the most eye-popping evidence of all, because its cloud backlog, which is essentially contracted future business, nearly doubled in a single quarter to around $462 billion, a 400% annual increase.
A backlog of $462 billion is essentially a giant pile of signed commitments waiting to be fulfilled. So help me understand how much of that actually turns into recognized revenue and when.
Google has said it expects to recognize just over half of that backlog as revenue over the next 24 months, which gives you a tangible near-term path for why the spending might genuinely be justified.
So the bull case is essentially that the contracts and the consumption are already there, the spending is chasing real demand, and these companies would actually be losing ground if they refuse to build this aggressively.
Precisely, and one analyst put it bluntly, calling the bearish thesis garbage, arguing that underbuilding right now would be the truly catastrophic mistake, because you simply cannot conjure data center capacity overnight when demand arrives.
That point about lead times is underrated, because power, land, permits, and chips all take years to line up. So if you wait until you're certain of demand, you've already lost the race entirely.
And that is why even nervous executives keep spending, because the asymmetry is brutal. The cost of building too much is some wasted capital, but the cost of building too little could be permanent strategic irrelevance.
Let's zoom out, because this isn't just a story about 4 companies. It's reshaping entire industries around them, from chip makers to electric utilities to the construction firms, physically pouring all of this concrete.
Absolutely, and the ripple effects are enormous, because $700 billion flowing into infrastructure creates a gravitational pull on power grids, semiconductor supply chains, and even the job markets in the regions where these centers rise.
It also raises a real question about energy, because all of this compute needs staggering amounts of electricity. And I have to wonder whether the power grid can actually keep pace with this breakneck construction schedule.
That is becoming the binding constraint, honestly, because in many regions, the limiting factor is no longer money or even chips. It is simply whether you can secure enough reliable power to turn the machines on.
So where does this all go next? Because if 4 companies are spending $700 billion this year, the obvious question is whether that number keeps climbing or finally hits some kind of natural ceiling soon.
The current projections are honestly hard to fathom, because analysts now expect big tech capital expenditures to top $1 trillion in a single year by next year, which would have sounded absurd not long ago.
$1 trillion in annual spending is the kind of figure that used to describe entire national economies, not the infrastructure budgets of a handful of technology companies competing in a single emerging market.
And that is exactly why this matters so much, because we are watching the largest, fastest corporate infrastructure build-out in modern history. And the verdict on whether it was genius or hubris is still very much unwritten.
That tension between genius and hubris is the perfect note to sit on. Because the honest answer is that we won't truly know for a few years, and both outcomes still feel completely plausible today.
My personal take is that the demand evidence is real enough that the builders are probably right to be aggressive, but the pace is so extreme that some painful corrections along the way seem almost inevitable.
That feels like a balanced and fair place to land, acknowledging both the genuine momentum and the very real risk, without pretending that anyone, including us, knows exactly how this extraordinary chapter ultimately resolves.
I completely agree, and the thing I'll be watching most closely is free cash flow, because that single metric will tell us whether this spending is sustainable or whether the bears were quietly right all along.
That's all for today's episode of the DX Today podcast. Thanks for listening, and we'll see you next time.